Hello, my name is Mitch DeWitt, and I'm a partner and financial advisor at Walkner Condon Financial Advisors. This is another video in our little mini-series on equity compensation. As I mentioned in the intro and some of the other videos, there are a lot of different flavors of how you can get compensated, and the umbrella term I use is equity compensation. This video is on stock appreciation rights. A lot of times you see the acronym SARs. Stock appreciation rights. First, I want to define what they are. Like the name implies, appreciation has a big thing to do with it. So you get granted a stock appreciation right, and the value of that ultimately comes from how much the underlying stock might appreciate. Now, it might not appreciate at all. It could depreciate. So I want to also mention there might be $0 of value in a stock appreciation right. However, you are aligned with your company. Could be public or private, but if the stock grows, you might benefit. So first, you get granted a stock appreciation right. That's number one. Number two is you'll have to vest. A lot of times it is based on the amount of time that you're with the company. There also could be some performance metrics that are linked to it, but you have to meet a vesting date. And then from there, you can then exercise your stock appreciation right. And by exercising, that basically means that if you were granted a stock appreciation right and it was at $10 a share, and let's say your company's stock went up to $20 a share, it doubled, that $10 that it appreciated is the value to you per stock appreciation right. Now, if you exercise, it depends on your plan, but you might get paid out in cash on that appreciation value, or you might actually get delivered stock at that point in time. So again, if it goes from 10 to 15 or from 10 to 20, whatever that spread is, they give you that amount in company stock. The next thing I want to talk about is taxation. That's a big thing that comes up. So when you exercise is when you ultimately will be taxed. You're not taxed upon grant. You're not taxed upon vest. You would be taxed upon exercise. And you're taxed on the amount that the stock appreciated. It's going to be taxed as ordinary income. And that also will mean Medicare, Social Security, payroll taxes will come from that as well. Lastly, I would like to encourage you to check out some of our other videos. We've got a lot of videos on this topic of equity compensation. There's different flavors, like I mentioned, options, restricted stock, etc. And it's something that we really get excited about talking about and then also educating our clients. So I would invite you to continue to watch those videos, check out the podcast, the blog, go to walknercondon.com. And if it makes sense, feel free to book a meeting and see if we can help.